Welcome, everyone. Hello. My name is Tom Steinley. I'm Managing Director of Business Development at Lear. I'm joined by our host, Head of Research and Co-Portfolio Manager, Jim Warner. We want to thank you for taking time out of your summer to join us for our July 2025 market and strategy update. Amazingly, we're halfway through the year, and what a 6 months it's been. Markets are at an all-time high after a rocky start and an April pullback that saw the S&P decline almost 20% from its previous high, and the Magnificent Seven declined about 30%. As a tactical manager, we excel in this type of environment. Our proprietary research, theme identification, and security selection often leads to outperformance, and certainly has this year in both market decline and recovery, which I'm sure Jim will get into in more detail. Couple of reminders: please ask questions through the Q&A button at the bottom of your screen, and I will be, all of us will be following up by sending you the compliance-approved replay of the webinar and accompanying slide deck. So with that, no further delays. Jim, let's jump right in.
Perfect. Great. Thanks, everybody. Just to echo Tom's sentiment, thanks for joining us. I know many of you may be on vacation, so I'm going to try to keep this tight, but definitely want to leave time for questions. As I share my screen here, the title for this month's webinar is it time for a bull market pause? We've obviously had a really big rip in the markets since the reciprocal tariffs were put on pause on April 9th. And there was a lot of catch up that was being played last June. I'm not going to tell you what the answer to this question yet, but that's hopefully what you'll stick around for. But also to Tom's point, on the very last, I initiated this new section or new slide at the very end of each webinar last month, and I did so this month as well. It's a little slide on what makes us different, and stick around for it because you're going to see the kind of outperformance that we had both on the downside and to the upside in the market in the recent period of volatility. Really underscores what we mean by tactical. So this past quarter, was an excellent quarter, 10.6% up for the S&P 500. Frankly, I put this histogram on the right, just going back to 1975. It was a really good quarter, but frankly, it wasn't one of the best that we've seen. It was 26th best in the last 50 years. But great quarter. And as we've said in a lot of our write-ups previously, the easy part is de-risking portfolios when uncertainty is growing. The hardest part is re-risking portfolios when uncertainty is high. And, we've done that successfully through this period of volatility. A lot of it we've detailed throughout our various newsletters and webinars of the past few months. So I encourage you to go back and hold us accountable to that, but that's what you'll see. But I think that this is the area of investing that separates us and our investment process from the rest of the investment managers. So, ask yourself during a period like this, how did my investment manager not only perform, but how did they communicate with me? Obviously for us, we believe in transparency and communicating what we think as frequently as we can. So what's in your portfolio and what's in your client's portfolio. As Tom just mentioned, the markets have hit new record highs. The S&P 500 finished June year to date up 6%, which frankly, nearly all of it came in the month of June. What we saw was, kind of a nice solid recovery in April and May. And then I think a lot of investors really missed that rally and had to chase it in June. So we saw kind of this really kind of nice upward trajectory really across the board. Where we sit here today for the S&P 500, if we look at the relative strength index, it's looking a little overbought. I just put this picture here of the RSI, the 14-day RSI, and above that 70 line is overbought. That's roughly where we're sitting. So we wouldn't be surprised if investors take some profits as we head into the deeper part of the summer. So obviously, one of the big things to talk about is last week's passage and signature into law of the One Big Beautiful Bill. this a lot of this had been priced into the market, but there are a lot of individual aspects of this bill that we don't think are priced in. And we'll have to probably wait some time to know exactly how impactful these individual provisions will be. But net, this bill looks stimulative to growth. Now, as most of you know, the most important part of this bill, and by the way, there's parts of this bill that are bad and parts of this bill that are good, but the most important part that got passed was the extension of the 2017 tax cuts. From our perspective as investors, we were very worried that those wouldn't get extended because if they didn't, we would be facing recession and some really serious headwinds as tax rates would be going up across the board very significantly. That, thankfully, we can take that risk off the table. And I think that's a very important thing to mention. In addition, by the way, I didn't even put this on this slide, but it just occurred to me that there was also a debt ceiling extension or increase. And so it takes that, piece of consternation out of the market, at least for the foreseeable future. So those are out of the way, which is great. But in addition, there were other tax reductions and benefits that were included in this bill. For you folks in states with higher state income tax, you'll be happy to know that your SALT deduction has increased from 10,000 to 40,000. There's obviously new deductions on tips and overtime wages, a higher standard deduction for seniors. There's a whole variety of little things. What they actually amount to net, it's hard to say, but basically it's positive and it means that it's more money in consumers' pockets, which means it'll hold up consumer spending and therefore the economy. So all, basically fairly stimulative for the economy. Hard to assess really to what degree, but it's, more good than bad. The real big potential swinger here for an improvement for GDP is the incentive for business investment. So, leading into this one big beautiful bill, there's been a series of like trillions of dollars of announced investments that various companies around the world are going to make in the United States, largely around building new facilities, manufacturing facilities, et cetera. Now, what this particular part of the bill does is it really aggressively permits depreciation as a tax deduction on the various capital assets that are put in place. And in addition, it includes the expensing of various research and experimental investments that companies are making. So this could, not overnight, but like over the long term, really create a very positive tailwind for GDP. The final thing I'll just mention, and I'm not going to touch on all the various different aspects of this bill, but because there's financial advisors on this call, the state tax exemption was increased to 15 million for individual filers and 30 million for joint filers. But net, I think what you're going to find is more money in people's wallets and more encouragement of business investment, which ultimately can lead to more jobs. Now, separately, what was also included was a very big boost to defense. And as most of you know, modernization of the military, global remilitarization, that's a big theme that plays out in our portfolios. And so this has been a big boost to those names. The defense budget was increased by 150 billion to roughly $1 trillion. The key priorities where market is being shifted are towards unmanned systems and drones, missile defense, space, munition systems, and importantly, hypersonics and solid-state rockets, general IT modernization and digital transformation, and you can read the rest. Our two key defense holdings, Kratos and CACI, have maximum leverage to these priorities. So, we are very, very happy with the way this part of the bill turned out with respect to these two holdings. So touching on tariffs and the trade deals as they are, at this moment, as most of you know, the July 9th deal deadline has been extended to August 1st. It looks like the U.S. is negotiating specific trade deals with about 18 major trading partners. There are essentially 3 preliminary deals that have been signed or at least agreed to with the UK, Vietnam, and to some degree with China. It appears that they're pretty close with India, Japan, Korea, and maybe even with the EU. So we're going to see lots of headlines. And as we know, and as we wrote about in one of our newsletters, part of President Trump's negotiating tactics is to make a lot of noise and to, throw around threatening statements and tariff numbers, et cetera, et cetera. Do not fall for any of it. It's nothing is done until it's done. And I think the reality is that the market, like us, is expecting that there'll be a generally favorable outcome, one that can be digested by the markets, largely because Trump won't settle for a bad deal. It's pretty clear that he won't, he's also okay with settling for a good deal. So our concern shifts less to what the outcome of these deals are and more to the timing of these deals. The longer it takes to get an outcome and clarity around these tariffs and the nuances of these trade deals, the longer business executives will wait to make critical business investments, whether it's in this country or elsewhere, that will drive growth. It'll also delay kind of once and for all, kind of understanding the true impact of these tariffs on inflation. Because there's still sort of this lingering concern, particularly with the Fed, that tariffs could induce inflation. So, again, our view is they're generally going to work out, I think, favorable to the US. There may be some specific individual stock outliers that get hurt. We've deliberately tried to avoid those places in the market. But ultimately, what we need is these deals to happen in a timely fashion so that we know the business leaders know the rules of the road going forward. Meanwhile, these tariffs are increasing revenues at a pretty dramatic pace. The chart, you can see the kind of ramp in the chart below. These are the customs receipts from tariffs on an annualized basis. And what you can see is that, and let me put a pause there to say we don't know what the ultimate outcome is going to be and where tariff revenues are likely to come in. I think we can all probably assume they're going to be better than the 80 or so ish million annualized that was taken in prior to these new trade deals. But whether they're persist at 266 billion, which is the annualized number for May, I don't know. Nobody knows. We'll have to wait and see. But the interesting part to this is that this is the receipts for tariffs is not being included in the various different think tanks and the CBO that have scored the One Big Beautiful Bill deficit impact. And so if when we looked across those various different think tanks, the general consensus is that over the next 10 years, the bill would create about a 2.5 to 3 trillion of additional deficit. Now we know that there's a constant GDP growth rate of 1.8% built in there, which, if this bill does what it's supposed to do, it should generate GDP growth north of that. But what also helps is tariff revenue. And if you take that 266 billion and multiply it by 10, you fill a lot of that gap that people are thinking will turn into a deficit. So wherever we turn out, these tariff revenues are turning into being an important part of closing a future deficit. I mean, because obviously there's no desire by either party to cut, expenses. And that's something that's been, a point of consternation for us, but, and certainly a point of consternation for the dollar. But the reality is there's no desire to cut really by either side, by either party in Congress. And so you have to essentially grow your top line to get out of this deficit problem. So one other big thing that has been talked about and President Trump's tweeted about even this morning is where are interest rates going? Right now, the market is assuming that the Fed doesn't cut much. Right now, as you can see from the Fed futures here, long about October, possibly at the September meeting, we might see a 25 basis point cut. Then we might see another one in the December, January timeframe. But we're not seeing, some major cuts, which is obviously what the president wants. But I think that's fine. But more importantly is just look at this trend line down. This is going to be important because if the economic data doesn't fall apart, and we don't see, a dramatic weakening in the labor market, The Fed will be gradually cutting rates over the course of the next year to get back to neutral, right? And I'll show you in the next slide that we're still at a very restrictive or relatively restrictive interest rate, paradigm right now. And so, if we sort of see these small cuts going forward, that would be very positive for the market, and you don't want to fight the Fed on that. So that's something that we would keep in mind as we think about kind of the next, kind of the next 12 to 18 months of this bull market. This is a chart that I've shown in, multiple times over the past year and a half. And one of the things that we have tried to point out through looking at what is the Fed funds effective rate, which today it's 4.3%, minus the core PCE inflation rate. And you look at that delta and you look at it going back to, say, 2000. And what you notice is every time it gets up to really high levels, we have a problem in the economy. So right after, it peaked here, we had the dot-com collapse and a shallow recession. The last time it peaked at high levels where basically rates were too tight relative to inflation, we had the global financial crisis, and then we got really tight to combat all of the inflation that was coming through the system in 22, 23, and to a lesser extent last year. And we still remain, even with some of the cuts that have happened, relatively tight. So the general consensus is that, the neutral rate where monetary policy is neither tight nor loose, is around 3%. So rates right now are roughly 130 basis points too restrictive. Now, the Fed has come out recently and kind of changed its tune. So for, the better part of the last couple of years, the story out of the Fed is, we are data dependent. And if the data tells us that we can cut rates, we'll cut rates. Well, the data has been telling us to cut rates now for several months, if not quarters, and yet there's been no cut. And the latest, narrative from the Fed basically came out during the last Fed press conference, where Powell basically said, "Well, we're worried about tariff-induced inflation." Okay, well, that's different. That's a different approach. So now we're worried about something that hasn't happened yet. And so but there has been some softening on that language that leads me to believe that there could be a growing voice of Fed voters that will cut as we get into the fall. From our perspective, there's really not a lot of inflation out there. One of our favorite measures to look at is Trueflation, which evaluates millions of real-time data points on inflation. Seems to be a better approach from our perspective than the clunky door-to-door approach, effectively, that the government uses. But hey, it is what it is. But if you look at it in a more digital approach, more modern approach, inflation's at 1.75%. And notably in this chart, you can see this pretty dramatic fall off over the course of the last month. So, what we would ask is, where is the tariff inflation? Maybe it's coming. Maybe it just takes longer to hit. And we'll adjust accordingly. But right now, it certainly seems that there is plenty of room on the inflation side for the Fed to start cutting. And then as we look to the labor market, it is still generally very solid. The unemployment rate's been hovering around, these low 4% rates for quite some time. That's great. Provides a great foundation for the economy and to grow, and for businesses to generate more earnings, which is great for asset prices. But we can start to see that it's taking longer for those that have been laid off to find a job. The continuing claims, as you can see on the right, is starting to kind of arc upward, and that's going to be worth watching. The other thing that we're watching, and this may have more of a longer term impact, is just what impact AI is going to have on labor. Right now, it sort of seems that it's really relegated to and localized within kind of coders in the tech industry, which is a really small number of total employed individuals in this country. But it could expand, and that's just something that we're going to keep an eye on. It's not an overnight issue, I think, but certainly as we get into next year and the year after, the labor intensity of this economy may decline based on AI, but who knows? It may rise as more manufacturing is shipped on shore. So let's talk about the portfolio. So we've got some key upcoming catalysts to talk about. First of all, summer vacation. Some of you may already be on it. A lot of New York, takes it in August. And after the big run that we had in April, May, and June, you don't need a big excuse to take some profits and take some risk down in your portfolio and enjoy your vacation. So that's a negative. On the positive side, we're going to see these trade deals in whatever form they come out, any form that is forward momentum, is progress, and relieves some of the uncertainty that has beset the market. I think there's some positivity already baked in for these, but still, that those when they actually happen, we can start to think a little bit more. Microscopically on like the impact of, a certain Japanese company, for instance, and maybe find some interesting values there. One question mark is going to be the 2Q corporate earnings season. That starts in earnest next week. I always say that earnings season is like a cold bucket of water. It is the truth and the reality of what's facing businesses versus the bullish sentiment in the market. And given that we've had kind of the run that we've had and we've hit record highs, I'd say that the hurdle to meeting that reality, for reality to meet that bullishness is a higher bar. So I think we're going to get a little volatility around that. And remember, when I say volatility, I say opportunity. So our stated purpose is to take advantage of those opportunities when they present themselves. Another positive will be once these earnings are done, companies can get back into the market and buy back their stock. And that's not an immaterial amount of buyers re-entering the market. So that actually ends up helping, particularly as we get into September, which is also when we'll have conference season. And it's really hard to say what's going to come out of executives' mouths, but we will be largely through Q3 at that point. So we may have a little bit better idea as to things like tariffs and how they're actually impacting their businesses. Again, this is an opportunity for clarity, and clarity is generally good for the market, but you never know what's going to come out. The other two positive things that I'll touch on is deregulation. And this is really something that we can think about probably over the course of the next year. In particular, in financial services, there is a push to unravel some of the belts and more suspenders that were put on banks to allow them to get back into the business of lending. For those of you who follow the market closely, you know that the private credit world has just been explosive. I think there's over $1 trillion of private credit chasing middle market loan deals. That used to be the domain of banks in this country, but banks have basically been regulated out of doing that. And arguably, they have a lower cost of capital than these private credit funds. So the ability for banks to get back into lending, particularly to smaller middle market, more risky businesses, I think is a net positive for GDP growth on whole. And so that's something that we're looking forward to. I expect that there'll be deregulations in a lot of other industries too that will be worth watching because it could be stimulative for growth. The last thing I'll mention is that, as I have already, is a Fed cut. So long as the economic data hasn't fallen apart, that would be positive. So, any sort of near-term pullback or pause we get into this market as folks kind of, enjoy the recent fruits of the market and put a pause on their own life to go off on vacation, I think that's just going to end up being a buy the dip opportunity. So for us, there's no change in our approach, which is what I call sniper mode. The market themes, what I've done here, the key market themes that I'd highlight. What I did here is I bolded and underlined the what's different from last month. But basically, obviously the market and the economy is still very solid. And now we have fiscal stimulus on the horizon with the one big beautiful bill being passed. We have a thawing trade war, and we're getting closer to fewer unknowns as more and more of these handshakes get made. There is still no inflation surge from tariffs. So we're now several months into this now, and we've yet to see it. You have Fed cuts in the fall. I think that's becoming more of a certainty than maybe a month ago. And then separate and apart, we've got a real growing theme in crypto. It is becoming a more and more real asset class, maybe as partly as a hedge, particularly as we see a weakening dollar, but partly as an actual investment opportunity, um, as some of these crypto miners are also really important contributors of capacity for AI data center space. So it's become a more important part of our portfolio over the last few months, and it's sort of exciting new thing to talk about. So from a market strategy standpoint, we're sticking with our themes because they are working. AI, electrification, military modernization, commodities, think copper, uranium, all been on a tear, gold, financials, next gen healthcare, Bitcoin. These are all been, terrific sectors that have, honestly, we think, pretty substantial secular tailwinds behind them. So as I mentioned, the next leg of the market may be choppy and narrower. Yes, we said that last month, but I think that's going to be increasingly true. And ultimately, for stock pickers like us, it really comes down to what is our confidence level in 2026 earnings. And honestly, there's a lot of things that are starting to line up that suggest that we should be more bullish on 2026. There's just a growing number of reasons. Obviously, I pointed to the budget bill getting passed. We'll have trade, behind us. And if you just stop and think about what's happened this year, all this volatility was basically politically created. I mean, I've referred to it before as it was man-made, so it could be man-fixed. Really, it was President Trump made. It could be President Trump fixed. But the reality is, we're going to put all that behind us as we look into 2026. So, we continue to be really bullish on technology. That's where there is enormous growth, particularly driven by AI, and there's better valuations to be found. The electrification theme continues to be, extraordinarily powerful. There just is not enough electricity generation in this country, and there's a real problem and potential for deficits in the coming years. When we first came upon this theme, and this is probably 3 years ago, we read this old piece, and I can't remember who it was written by, but it was probably written in the 1950s or 60s about how ultimately the growth in energy consumption in an economy is the core driver of future GDP growth. And you sort of read that and go, oh, that's interesting. But, this is back when energy was only growing at, GDP, type growth rates. Now it's becoming abundantly obvious through the adoption of AI that we need a heck of a lot more of it. And so this has turned basically a very boring industry and boring companies into super growth companies. And that's been a great trend that I think will continue for quite some time. We continue to like gold, even though it's worked so great over the last, year or two. If you've got concerns about deficits and you got concerns about the value of the dollar, it's still a great place to be. And Bitcoin too is becoming a better and better choice or alternative to fiat currency. We talked about how bullish we've been on copper and uranium. Just this morning or just yesterday afternoon, President Trump announced 50% tariffs on copper imports. We didn't know that this was actually going to happen. We suspected it might, but it's certainly as part of the electrification theme, there is going to be a surge in demand for copper over the course of the next decade. And so we bought Freeport-McMoRan in a lot of portfolios and bought copper in other portfolios, our more ETF-oriented portfolios. And that has been a terrific call. The Freeport-McMoRan is specifically basically supplies about 50% of the copper that U.S. manufacturers need. They do so from U.S.-based mines. And so they are just in a premier position to take advantage of higher copper prices. So we're excited about that. So at the end of the day, what we're doing right now is being pretty disciplined after this big rip in the market. We're going to spend a lot of time thinking and analyzing earnings as they come about. It's a little harder to find overlooked value, although there's still some in financials, and so we've been increasing exposure there. We're still looking to expand internationally, particularly to places like Japan. And with trade deals in hand, this could be, an easier task. of finding opportunities there. And and then we are trimming some winners, being mindful of the tax impact. But certainly after the move we've had in some of these portfolios, it's nice to take some profits. So let me just quickly go through these accounts, just four of our top strategies, and then I'll get to kind of what makes us different slide that I teased earlier. Our tilt strategy, which is our most aggressive equity-based strategy, has had an unbelievable year. It's up over 20% year to date, 30% over the last year. This has been, really benefited from a lot of solid stock picking. We recently increased our crypto bet by buying Riot Platforms. But you can see we've got some really fun, powerful themes in here, whether it's drones or AI or even, something as simple as copper miners. Those have been a terrific place to be. And while there's overlap between tilt and moderate does have a higher component of fixed income. And some overlap in the stocks, although some of the stocks are a little bit more conservative than what you would find in the tilt portfolio. But nevertheless, it's done terrific, way outperforming indices, up about 13% year to date, 20% over the last year. And I always say I'm always most proud of this number down here, the 7.5% annualized return for over the last 10 years, after fees, is a remarkable accomplishment for a moderate risk fund. When we set out to create Global Vigilance, the idea was to deliver equity-based strategies without taking equity risk. Sounds pretty awesome, right? The reality is, I think we've done a decent job of doing that, where you get that kind of equity-like return of 7.5% that compounds wealth over time. And you only do that unless you have a very established, effective investment process and you know how to manage risk. So we're most proud of that. And in this one, we actually bought Flagstar, a bank. Actually, I'll take a second to just mention that this is a really good case in point of one of the ways we manage taxes. So Flagstar was a business that it's a bank. It's in New York City. It's a great turnaround story. We love it. We think it's could have huge upside in the future. But it's taking the market a little bit of time to get used to it. And during the April downturn, it sold off pretty decently. We used it as an opportunity to take tax losses, because there's a lot of tax gains, frankly, in a lot of portfolios right now, just due to the way the portfolios have behaved. And then we waited our 30 days and we re-entered the stock at roughly at or where we exited it. So great example of how we tax loss manage portfolios. And this, by the way, flows through our models too. So that's people who own the models benefit from that kind of tax loss harvesting mindset. And then our conservative strategies continue to do amazing as well. It's up 11% for the year, and it's delivered 5.8% over the last 10 years annually. We added some copper exposure there. And then our enhanced yield product, which is meant to compete with the high yield index without taking the same level of credit risk, has hung in there and done pretty well, up a little over 4%. So, all in all, we're really, really happy with the way the positioning has really worked out this year in our portfolios. There's a whole bunch of reasons why it's worked out great, but ultimately, when we call ourselves tactical, we really mean it. A lot of people out there are tactical imposters. They don't know how to really move risk around in a portfolio to protect on the downside, and then more importantly, to re-risk on the upside. As you can see from these two charts, our Global Vigilance moderate strategy versus the S&P on the left and tilt on the right. The top blue line is the Global Vigilance strategy. The bottom gray line is the S&P 500. You can see that we went down less and we've gone up more in the recovery. So in the drawdown, Global Vigilance moderate went down 7.8%, tilt went down 10, and the S&P went down 15. So we protected capital on the way down, even in our most aggressive strategy. And then they've bounced back better. GV moderate is up. Global Vigilance moderate's up 22. Tilt's up 34. The S&P is up 25. You say, wait a minute, Global Vigilance is beating, moderate is below the S&P 500. Yes, but we're also carrying 32% fixed income in cash. So to basically keep pace with an all equity index means we did a couple of good things in that portfolio. So let me stop there, Tom, and let's take questions if you guys have some. I'd love to take them.
Yeah, great, Jim. Yeah, I see that there were several people that logged onto the call after we did the initial intro, in which I suggested if you have questions, just use the Q&A box at the bottom of the screen. We can stay on for another couple of minutes if there are questions, but we realize everybody's busy, so if there aren't, we'll wrap it up and move on. But I'm gonna just wait for 30 or 40 seconds, Jim, in case we get somebody who wants to ask a question. It is clear, I love this slide, and it is clear that the market we've been in over the last year or so is much more a stock pickers market than it is an indexers market. And being a manager of a high concentrated portfolio of high conviction securities, your analogy of being in sniper mode is right on, right? We want to own specific names in in specific industries or themes, and that seems to be playing out very nicely. I do not see any questions, and we're butting up on about 40 minutes. So, and hold on a minute. We got one. All right. Well, thank you, Frank. We appreciate it. There were no questions, but he did appreciate the content of the presentation, and thank you for that. We appreciate your compliment, Frank. So with that, I think we should wrap it up. It is summer. We will be doing this first week in August again. If you're on vacation between now and then, enjoy. Thank you for tuning in, and we'll reconvene again in another 3 weeks to a month. All right. Thanks so much.
Thanks, everyone.